Ang susunod na programa ay rated PG. Patnubay at gabay ng magulang ay kailangan sa mga batang manonood.
Alam mo ba yung pakiramdam na parang hindi ka pinipili? Hindi ka pinipili ng tadhana, ng tagumpay, parating naiiwan at napag-iiwanan. Sa buhay, hindi laging masaya. Nariyan ang pagkakataong tayo ay nalulungkot, nasasaktan at nagdurusa. Hindi mo ba napapansin? Lagi ka na lang huli. Lagi ka na lang nasasaktan. Mapapatanong ka na lang, ako ba itong nagkamali? Ako ba itong nagkulang? O hindi lang talaga para sa akin? Baka nga, hindi ko deserve ang maging masaya. Sabi nila, hindi patas ang mundo. At kung minsan, patuloy nating sinisisi ang mundo sa lahat ng mga hindi magandang sandali na ating naranasan. Pero, ang mundo ba talaga ang hindi patas? O ang mga taong nakapaligid sa atin ang hindi patas? Lahat tayo ay may iba't ibang kinakaharap sa buhay. Yung iba sa atin, kailangang magsakripisyo. Kailangang tumigil mangarap at magpalunod sa mga responsibilidad na kung saan kailangan mong magdusa para lang mabuhay. Tandaan, kahit ang pinakamalakas na tao ay napapagod din. Pinakamalakas tumawa, pinakamabilis umasa, ang laging nandyan para sa iba ay ang taong naghahangad ng pagmamahal, pangangalaga, at nangangailangan din ng tao para sa kanila. Kailangan mong tanggapin na minsan ang mga magagandang bagay ay nagtatapos. Na minsan, ang mga tao ay umaalis. At hindi sa lahat ng oras, kailangan mong magpanggap na masaya at malakas. Kailangan mo ring gumaling. Dahil deserve mo ito.
But I've got secrets I can't confess. Don't say you love
Hindi sa lahat ng bagay
cause I don't
kailangan mong magmadali.
those words. It's getting hard.
Kailangan mo ring magpahinga. Pero hindi ibig sabihin nun ay sumusuko ka.
You need to tell
Ayos lang ang magdahan-dahan. Okay lang na maglaan ng oras na kailangan mo. Nabubuhay man tayo sa henerasyon na kung saan sinusulong ang pagiging mabilis hanggat maaari pagdating sa karera, sa ating kinabukasan at sa ating tagumpay sa buhay.
Away for the waves to leaving calm. Think I'm breaking. I'm a mess in the making.
Kaya magpatuloy ka dahil kailangan ng mundo ang iyong pagiging natatangi. Ikaw ay may kakayahang gumawa ng isang bagay na maganda sa iyong buhay. Huwag hayaang kumbinsihin ka ng mga hadlang sa kalsada o pagdududa sa sarili para ikaw ay matakot sumubok at bumangon sa buhay.
Holding on a tighter rope.
Harapin ang mga pagsubok,
Coming home. Hurting.
tanggapin ang pagkakamali at pagkatalo.
Coming home.
Dahil ang lahat ng ito ang magtuturo at gagabay sa iyo sa mas mabuting buhay at magdadala sa iyo para sa mas magandang bersyon ng iyong sarili. Sumubok lang at magpatuloy dahil kung ito ay para sa iyo, magtiwala na mahahanap ka nito.
Good day everyone, my name is Kristen May Bustalino from Group Izika. In this video, I will be discussing about capital structure. Capital is the major part of all kinds of business activities, which are decided by size and nature of the business concern. Capital may be raised with the help of various sources. If the company maintains proper and adequate level of capital, it will earn high profit and they can provide more dividends to its shareholders. Capital structure refers to the kinds of securities and the proportionate amounts that make up capitalization. It is mixed of different sources of long-term sources such as equity shares, preference shares, debentures, long-term loans, and return earnings. Refers to the relationship between the various long-term source financing such as equity capital, preference share capital, and debt capital. Deciding the suitable capital structure is the important decision of the financial management because it is closely related to the value of the firm. Capital structure is the permanent financing of the company represented primarily by long-term debt and equity. According to the definition of Gerstenberg, capital structure of a company refers to the composition or makeup of its capitalization, and it includes all the long-term capital's resources. According to the definition of James C. Van Horn, the mix of a firm's permanent long-term financing represented by debt, preferred stock, and common stock equity. And according to the definition of Prasanna Chandra, the composition of a firm's financing consists of equity, preference, and debt. And lastly, according to the definition of R.H. Wessel, the long-term sources of fund employed in a business enterprise. The term financial structure is different from capital structure. Financial structure shows the pattern total financing. It measures the extent to which total funds are available to finance the total assets of the business. The following points indicate the difference between the financial structure and capital structure. Financial structures includes both long-term and short-term sources of funds. It means the entire liability side of the balance sheet. Financial structure consists of all sources of capital, and it will not be more important while determining the value of the term. While capital structures includes only the long-term sources of funds, it means only the long-term liabilities of the company. It consists of equity, preference, and return earning capital. and it is one of the major determinations of the value of the firm.
Good day everyone, I'm Jacarta Aquino, and for today's video I'm going to discuss the optimum capital structure, its objective, forms, and factors. So what is optimum capital structure? So it is the capital structure at which the weighted average cost of capital, or WACC, is minimum and thereby the value of the firm is maximum. Optimum capital structure may be defined as the capital structure or combination of debt and equity that leads to the maximum value of the firm. Optimal capital structure is referred to as the perfect mix of debt and equity, financing that helps in maximizing the value of a company in the market while at the same time minimizes its cost of capital. So capital structure varies across industries. An example of optimum capital structure is when debt investors face lower risk because they would be the first to get their money back in the event of company's bankruptcy. So therefore, they accept a lower rate of return and the company has a lower cost of capital, issuing debt compared to equity. Next is the objectives of capital structure. So the decision of capital structure aims at the following two important objectives, which is to maximize the value of the firm and minimize the overall cost of capital. Forms of capital structure. So capital structure pattern varies from company to company and the availability of finance. Normally, the following forms of capital structure are popular in practice. First is equity shares only, equity and preference share only, equity and debentures only, and last equity, shares, preference shares, and debentures. The next is the factors determining capital structure. So leverage and cost of capital are considered while deciding the capital structure of the firm. What is leverage? So it is a basic and important factor which affect the capital structure. It is used as the fixed cost financing such as debt, equity, and preference share capital. It is closely related to the overall cost of capital. So leverage is the use of debt or borrow capital in order to undertake an investment or project. The result is to multiply the potential returns from a project. At the same time, leverage will also multiply the potential downside risk in case the investment goes not pan out. When one refers to a company, property, or investment as highly leveraged, it means that item has more debt than equity. The next is cost of capital. So it is referred to the return a company expects on a specific investment to make it worth the expenditure of resources. In other words, the cost of capital determines the rate of return required to persuade investors to finance a capital budgeting project. Cost of capital is important because businesses and financial analysts use the cost of capital to determine if funds are being invested effectively. If the return on an investment is greater than the cost of capital, that investment will end up being a net benefit to the company balance sheet. Conversely, an investment whose return are equal to or lower than the cost of capital indicates that the money is not being spent wisely. So how to calculate cost of capital? So here we're going to use the weighted average cost of capital or WACC. To calculate the weighted average cost of capital, you must first calculate the cost of debt, the cost of equity, which are represented by these formulas. Cost of debt refers to the interest rates paid on any debt, such as mortgage and bonds. Interest expense is the interest paid on current debt. So this is the formula to calculate the cost of debt. Cost of equity. It refers to the return a company requires to determine if capital requirements are met in an investment. Cost of equity also represents the amount the market demands in exchange for owning the asset and therefore holding the risk of ownership. The cost of equity is approximated by Capital Asset Pricing Model or CAPM. So this is the formula to calculate the cost of equity. RF is risk-free rate of return, RM is market rate of return, and beta is your risk estimate. So weighted average cost of capital. The cost of capital is based on the weighted average of the cost of debt and the cost of equity. So this is the formula to calculate the cost of capital. In this formula, E is the market value of the firm's equity, D is the market value of the firm's debt, B is the sum of E and D, RE is the cost of equity, RD is the cost of debt, and PC is the income tax rate.
Capital structure. It is the major part of the firm's financial decision which affects the value of the firm, and it leads to change EBIT or earnings before interest and taxes, and market value of the shares. The aim of effective capital structure is to maximize the value of the firm and to reduce the cost of capital. And there are two major theories that explains the relationship between capital structure, which is cost of capital and value of the firm. Cost of capital. It represents the return a company needs to achieve in order to justify the cost of a capital project, such as purchasing new equipment or constructing a new building. Cost of capital encompasses the cost of both equity and debt, according to the company's preferred or existing capital structure. While value of the firm is independent of capital structure decisions, given the tax deductibility of interest, adding leverage increases firm value up to a point but also increases the risk of default for capital providers who demand higher returns in compensations. It is calculated as the sum of a market value of all outstanding securities, which consists of common shares, preferred shares, and debt. This measure is calculated by comparing the market value of capital with the adjusted value of capital. Capital structure theories are based on a certain assumptions to analyze in a single and convenient manner. First, the firm uses only two sources of funds, which is debt and equity share capital. The firm needs to pay 100% of its earning as dividend. The dividend payout ratio 100%, which means that there is no scope for the retained earnings. The total assets are given and do not change. That means there is no change in investment decisions or in the firm's total assets. The total finance remains constant. It means the total financing remains constant through balancing taking place in between the debt and share capital. The operating profits or EBIT are not expected to grow. No income is written. The business risk remains constant. Means the business risk is unaffected by the financing mix. The firm has a perpetual life. The investor behaves rationally, and the effect of taxes are ignored.
Net income approach suggested by Duran. According to this approach, the capital structure decision is relevant to the valuation of the firm. In other words, a change in the capital structure leads to a corresponding change in the overall cost of capital as well as the total value of the firm. According to this approach, use more debt finance to reduce the overall cost of the capital and increase the value of firm. Net income approach is based on the following three important assumptions. First, there is no corporate taxes. Second, the cost debt is less than the cost of equity. Third, the use of debt does not change the risk perception of the investor. Where V equals S plus B, V value of firm, S market value of equity, B market value of debt. Market value of equity can be ascertained by the following formula. S is equal to NI over KE. where NI means earnings available to equity shareholders, KE, cost of equity or equity capitalization rate, format for calculation, value of the firm on the basis of NI approach. Particulars: net operation income or EBIT, less interest of debentures, I, earnings available of equity holder, NI, equity capitalization rate, KE, market value of equity, S, market value of debt, B, total value of the firm, S plus B, overall cost of the capital, KO, is equal to EBIT over V multiplied by percent. And now let us proceed to exercise 3. A company expert a net income of Rs 100,000, it has Rs 250,000 and 8% debentures.
The quality capitalization rate of the company is 10%.
Calculate the value of the firm and the overall capitalization rate according to the net income approach, ignoring the income tax. B. If the debenture debts are increased to Rs 400,000, what shall be the value of the firm and the overall capitalization rate? Solution: A. Capitalization of the value of the firm. Net income 100,000 minus less interest on 8% debentures of Rs 250,000, 20,000 is equal to earnings available to equity shareholders 80,000 divided by equity capitalization rate 10% is equal to 80,000 divided by 10 times 100. In here, we're going to use the formula of V is equal to S plus B. Market value of equity, 800,000 plus market value of debentures, 250,000 is equal to value of the firm, 1,050,000. Calculation of the overall capitalization rate. Overall cost of capital, KO. Calculation of the overall capitalization rate. Overall cost of capital, or KO, is equal to earnings divided by value of the firm, or EBIT over V. Our earnings is 100,000 divided by 1,050,000 times 100 is equal to 9.52.
Hi guys, I'm Christine Roques and I'm going to discuss about the net income approach of valuing a firm and assumptions of net income approach. Net income approach of valuing a firm. The theory of the net income approach suggests increasing the value of a firm by decreasing the overall cost of capital. The cost of capital in the theory is measured in terms of weighted average cost of capital, or WACC. WACC is the weighted average cost of equity and debts, and the weights are the units of capital collected from each source. The net income approach stresses on the fact that with the increase in financial leverage or the proportion of debt, the WACC decreases and the value of the firm increases. Alternately, if there is a decrease in leverage, the WACC will increase, and thereby the value of the firm will decrease. Here's the calculation of the value of the firm of debentures debt is raised to Rs 300,000 pesos. Net income 100,000 pesos. Less interest or 8% debentures of Rs 400,000 pesos is 32,000 pesos. Equity capitalization rate 68,000 pesos divided by 10%. Market value of equity 68,000 pesos times 100 divided by 10 is equal to 680,000 pesos. market value of debentures 400,000 pesos, value of firm 180,000 pesos, overall cost of capital 100,000 pesos divided by 180,000 pesos times 10 is equal to 9.26%. Assumptions of net income approach. Net income approach makes certain assumptions which are as follows. The diminishing debt will not let confidence levels of the investors come down. Only two sources of finance like retained earnings and preference share capital are considered. All companies must have a uniform dividend payout rate which is 1. There are no costs such as flotation costs, no transaction costs, and corporate dividend tax. The capital market is operating perfectly, which means information about all the relevant companies is available to all investors. There are no opportunities for overpricing or underpricing of security. All sources of funds are perpetuity, which means the finance is for infinity. Moreover, there are no redeemable sources of finance. Generally, in case of the net income approach, with an increase in debt, the total market value of the company increases while the cost of capital decreases. Moreover, the cost of debt stays lower than the cost of equity, so when the debt finance is increased, WACC reduces, thereby increasing the value of the firm.
Good day everyone, I am Mary Love Seno and today I am tasked to discuss with you what is Net Operating Income Approach or NOI. This is another modern theory of capital structure. It is suggested by David Duran. This is just the opposite to the net income approach. According to this approach, a capital structure decision is irrelevant to the valuation of the firm, which is why this approach is also called the irrelevant theory. The market value of the firm is not at all affected by the capital structure changes. According to this approach, the change in capital structure will not lead to any change in the total value of the firm and market price of shares as well as the overall cost of capital. NOI approach is based on the following important assumptions. First, the overall cost of the capital remains constant. Second, there are no corporate taxes. And third, the market capitalizes the value of the firm as a whole. Now, the value of the firm, which stands with letter V, can be calculated with the help of the following formula as shown on the presentation, where V is the value of the firm, EBIT is the earnings before interest and tax, and KO is the overall cost of capital.
Good day, co-learners. I'm Christian Ivan Cola, and today I'm gonna report how to calculate the market value of firm and cost of equity using the formula of NOI or the net operating income approach, which has been discussed by Ms. Seno. Let's try to solve this case. Allegria Company Ltd expresses a net operating income of 200,000 pesos. It has 800,000 pesos to 7% debentures. The overall capitalization rate is 10%. A. Calculate the value of the firm and the equity capitalization rate or cost of equity according to the net operating income approach. If the debenture debt is increased to 1,200,000, what will be the effect on the value of the firm, the equity capitalization rate? Here's our solution. So we have the given net operating income is equal to 200,000 pesos, and overall cost of capital or RKO is equal to 10%, and market value of the firm, and that's what we are going to find out, the market value of the firm. Remember that. Okay, the D or the debentures is equal to 800,000 pesos. I is equal to 7%. So just ready your calculator because we're going to solve this problem using the formula of NOI or the net operating income approach. Our formula for this one will be NOI or EBIT, or just write EBIT divided by overall costs of capital or KEO times 100. The 100 here is as is. So just remember that one. Let's substitute all the given value. Remember, we are in the letter A. Don't be confused, alright? So, the EBIT will be 200,000 pesos divided by 10, our KEO, 10% times 100. So, it will give us 2 million pesos. So, and that is our market value of firm, 2 million pesos. So, our last market value of the debentures, we know this already that we have 800,000 from our given. So, in order for us to get the market value of equity or the total value of equity, let's just subtract the market value of firm and the debentures. So, it will give us 1,200,000 pesos. In our problem, we have to get the equity capitalization rate or cost of equity or KE. Also, we have a formula for this one. The formula will be K is equal to EBIT minus interest of debt divided by value of firm minus debentures times 100. Using the formula, let's substitute all the value. 200,000 or our EBIT minus 56,000 divided by 2 million minus 800,000 times 100. And we have 144,000 divided by 1,200,000 times 100. Therefore, our KE or our cost of equity will be 12%. Where I is equal to interest of debt, V is the value of the firm, D is equal to value of debt capital. In order for us to get the interest of debt, we have to multiply the debentures times the rate. Then that will give us 56,000. Our V is equal to 2 million and our D is equal to 800,000. Alright, let's move on to letter B. If the debenture debt is increased at 1,200,000 pesos, the value of the firm shall change to 2 million pesos. For this problem, we have to use again the equity capitalization rate or cost of equity formula. So the formula will be K is equal to EBIT minus interest of debt divided by the value of firm minus debenture. Alright, let's write all our given for us not to confuse. Okay? So EBIT or earnings before interest and tax is equal to 200,000 pesos. The I is equal to the value of the debt times interest rate. Then 1,200,000 times 7% is equal to 84,000. Then our V is equal to 2 million pesos. Our D is equal to 1,200,000 pesos. Let's substitute all the value if we are done writing our given. So using the formula, 200,000 minus 84,000 divided by 2 million minus 1,200,000 times 100. Therefore, our cost of equity will be 14.5%. And that's how easy it is to calculate the cost of equity. And that's all my part, and thank you for listening.
Even
Good day everyone, my name is Eliza Alcala and I'm going to talk about the summary of Modigliani and Miller theory or approach. The M&M theorem or the Modigliani-Miller theorem is one of the most important theorems in corporate finance. As the name suggests, it was derived by two economist people named Franco Modigliani and Merton Miller. The MM theory explains the effect a firm's capital structure may have on the value of the company for investment purposes. But what is capital structure, by the way? Capital structure is the particular combination of debt and equity used by a company to finance its overall operation and growth. And it is one of the most important factors influencing investment decision is the capital structure of the firm. As an investor, you may choose to invest in an equity-only firm or debt-equity firm. To ease this decision-making process, Modigliani and Miller approach is the way to solve the phenomenon in the capital structure. The definition states that the market value of company is calculated using its earning power and the risk of its underlying asset, and that its value is independent of the way it finances investment or distribute dividends. A simple way to arrive at the market value mentioned in the theory is to multiply the firm's number of shares outstanding by the current stock price. The theory indicates that from an investor's point of view, the value of levered firm with debt and levered firm without debt is the same. It states that the market value of a company is correctly calculated as the present value of its future earnings and its underlying asset, and it is independent of its capital structure. Through Modigliani-Miller approach, it helps us to understand the relationship between a company's capital asset structure and dividend policy and its market value and cost of capital. The theorem also demonstrates that how a manufacturing company funds its activities is less important than the profitability of those activities. So the main idea of this theory is that the capital structure of a company does not affect its overall value. And that would be all. Thank you.
Hello everyone, my name is Shella J. Montifalcon and I am going to talk about the M&M approach assumptions. M&M approach assumptions are unrealistic. It assumes that there are perfect capital markets that don't exist. It ignores the corporate tax and personal taxes that is not practically viable as shareholders pay taxes on the capital gain. Following are the M&M approach assumptions. The securities are traded in the perfect market situation. In a perfect capital markets, the perfect market conditions applies to the securities that are traded in a share market. It makes sure that the investors of the market can buy or sell securities without any restrictions. The investors in a perfect market are allowed to borrow at the same cost at which they lend and they invest rationally. And the next assumption is that firms can be grouped into homogeneous risk classes. Homogeneous risk. There are companies in the market that fall within certain homogeneous classes. There may be classes depending on the nature of industries that can cause the same homogeneous risk for the firms. And these companies are believed to have similar operating risks and they fall within the same groups considering the risks they are subjected to. And these firms that can be grouped into homogeneous risk classes can be the business risk and the tax risk. The business risk. The risks associated with the firms arise from the operating risk and are defined in terms of net operating income. The risk to investors arises both from fluctuations of NOI and the fact that there may be variance in the actual outcome of risk due to variables that affect the outcome. In other words, the risks of the firms originate from the fluctuations of NOI and the possibility that the value of actual variables may be different from the actual estimate. Next is the tax. The theorem considers that there is no tax payable by the firms. This means that there is no tax saving from the interest payable to the debts. Tax deductions not being applicable, the companies may have to incur no cost in taxes that are liable to be paid otherwise. Next assumption is that the expected NOI is a random variable. Under the net operating income approach, the cost of equity is assumed to increase linearly with average. The next assumption is that firm distribute all net earnings to the shareholders, or it is called the full dividends payout. The theorem states that companies must pay all net earnings to the shareholders. In other words, the company should distribute 100% of its net earnings as dividends. And the last assumption is that no corporate income taxes exist. There is asymmetry of information. This means that an investor will have access to the same information that a corporation would, and investors will thus behave rationally. The cost of borrowing is the same for investors and companies. To summarize it all, M&M approach assumptions are the following. First, the securities are traded in the perfect market situation. Second, firms can be grouped into homogeneous risk classes. Third, the expected NOI is a random variable. Fourth, firm distribute all net earnings to the shareholders. And the last, no corporate income taxes exist.
Good day everyone, so now let's talk about the M&M theorem in perfectly efficient markets. This is the first version of the M&M theorem with the assumption of perfectly efficient markets. The assumption implies that the company operating in the world of perfectly efficient markets do not pay any taxes. The trading of securities is executed without any transaction costs. Bankruptcy is possible, but there are no bankruptcy costs and information is perfectly symmetrical. So, let's go to proposition number 1. The formula is V sub L is equal to V sub U, where V sub U is equal to value of the unlevered firm, and then V sub L is the value of levered firm. The first proposition essentially claims that the company's capital structure does not impact its value. Since the value of a company is calculated as the present value of future costs, the capital structure cannot affect it. Also, in perfectly efficient markets, companies do not pay any taxes. Therefore, the company with a 100% leveraged capital structure cannot obtain any benefits from tax-deductible interest payment. Okay, now let's go to proposition number 2, where the formula is R sub E is equal to R sub A plus D over E, open parenthesis, R sub A minus R sub D, close parenthesis, where R sub E, cost of levered equity, and then R sub A is equal to cost of unlevered equity. R sub D is cost of debt, and then D over E is equal to debt to equity ratio. The second proposition of the M&M theorem states that the company's cost of equity is directly proportional to the company's leverage level. An increase in leverage level induces a higher default probability to a company. Therefore, investors tend to demand a higher cost of equity to be compensated for the additional risk. Okay, now let's continue. Let's talk about the M&M theorem in the real world. So, conversely, the second version of the M&M theorem was developed to better suit real-world conditions. The assumption of the newer version implies that companies pay taxes, there are transaction, bankruptcy, and agency costs, and information is not symmetrical. So, proposition number 1, as you can see this as a formula, whereas T sub C is equal to tax rate, and then D is equal to debt. This first proposition states that the tax shields that result from the tax-deductible interest payments make the value of leveraged company higher than the value of an unlevered company. The main rationale behind the theorem is that the tax-deductible interest payments positively affect a company's cash flows. Since a company's value is determined as the present value of the future cash flow, the value of a leveraged company increase. Okay, now let's continue. Let's go to proposition number 2. That is the formula. I'm having hard time reading that formula, but that is the formula. So, the second proposition of the real-world condition states that the cost of equity has a directly proportional relationship with the leverage level. Nonetheless, the preference of tax shields affect the relationship by making the cost of equity less sensitive to the leverage level. Although the extra debt still increases the chance of company default, investors are less prone to negatively reacting to the company taking additional leverage, as it creates the tax shields that boost its value.